Okay, guys, I understand that a lot of people have questions regarding gamma, but this lesson, I'm going to strictly just stick to the vertical debit call spreads. All right, they're also known as the bull call spreads. Depends on how what people name it. They're called bull debit spreads, vertical call spreads. But basically, in simple terms, right, in order for you to understand this better, if you know options Greeks, you will be able to make much better decisions when playing with vertical call spreads. Or if you're very good at spotting bottoms, like that can last for 3-4 days, you can make a lot of money from vertical debit call spreads. All right. So basically, first, when the vertical debit call spread, we play them on two scenarios. Number one, when you think the market, or let's just say the stock price holds, that's your number one reason. Number two, you think the options alone are too expensive, or you believe the stock goes up or even remains sideways. All right. Or three, when you want to play far out or even cheaper, right? When you want to finance your option, like for less. Now, basically, what this means on vertical call spreads, you're buying one call, you buy one call. Now, I'm only discussing vertical debit call spreads, okay? Bull call spreads, when you think the stock either holds a certain price or it goes up in value, all right? And then you sell one call. Now, for example, once you understand the basic fundamentals of this, it will be much easier for you to understand what exactly this means, right? So for example, Apple, if you think it's putting in a bottoming pattern, here, right here. Now I have Apple open. Now I will be using Apple as my main go-to, okay, just one stock, so it makes more sense to you guys. Let's say, for example, Apple is here at a strong support level. All right, Apple here is at a strong support level. Now, I'm just using this one as scenario, but you can play vertical call spreads anytime in an uptrend and a downtrend, anytime you wish to, okay? And once you understand what they are, then it will make more sense to you. So let's say Apple, you think is going to bottom here. You think 139 level holds. This is just an example I'm using, guys, okay? Keep this in mind. You think that 139 level holds. Now, let's say 139 call, you buy. Let's say this call is priced at just a random number with the increased IV. Let's say it's priced at $2.50, okay? 139. So Apple's current price, so Apple currently is trading at, let's say 139.20, just an example. Current price, okay? This is the current price of Apple. Oh my. So this is the current price of Apple. The current price, all right? So now here I'm using a practical example to show you guys, right? What the vertical debit call spreads are basically. So you say, you know what? I think this 139 call, $2.50, you think is expensive. The intrinsic value, the first thing you want to understand is the intrinsic value on the call, if you think it's even worth playing it. So if Apple's trading at 139.20 and 139 calls are 250, what's the intrinsic value? Let's say you're buying it for this week. The intrinsic value is 139 plus 250. Yeah, which equals how much? 141.50, right? So let's say Apple, if it goes sideways here, does nothing. In order for you to break even on this 139 call, Apple needs to close at 141.50 at least by Friday. Unless it gives you a fast move right away in the next 1-2 hours or next day, this will gain some delta. But this also has something called theta time decay that will be taken out, so you don't make as much money. All right, well, 141.50 is your intrinsic value on 139 call alone. Well, now let's say you think Apple has a good chance. You think Apple has a good chance of closing, your prediction, we can say, for example, you think Apple has a great chance of closing in at, let's say you think Apple closes at 142 maybe. Apple closes at 142. If Apple does close at 142 by Friday, let's say you hold it till then, in the current Apple chops, it doesn't do much. What's the maximum value this call will have? The max value will be how much? $3. So your profits are only how much? Only 50 cents. That too, if you hold this. Now, if Apple doesn't do anything, it comes down, you're going to lose a lot of value from these options. They can go down a lot. They're pretty expensive. So you need a big time to play. But let's say you say to yourself that, you know what? I want to play this in a cheaper way. I want to be able to play this and still make money if Apple closes, let's say at 142. You want to take more advantage. So what would you do here? You would look at the further strikes, maybe the 141 strike, or maybe let's say even the 142 strike. you would look at the 142 strike and you would sell 142, the top resistance, right? Or whatever the resistance level is, depending on, you can choose any strikes here, by the way. And we'll go in more tips and details, but this I'm just going to explain first what it means. You sell 142 calls. Let's say these are priced at roughly $1, for example. All right. Now here you paid 250. All right. Right. And then here you collected. All right. You collected. Paid is usually known as debit. Collected is usually known as credit in the financial worlds. All right. In the stock options. So here your total cost of the spread is how much? Is 250 minus 1. So you're using this total spread for $1.50. So now your 139 calls are basically calling you for costing you 150. What's the catch here? Your maximum returns are limited. Your maximum returns are limited here. What do I mean by that? Your maximum profit. First thing you want to do is calculate your max profits here. Your max profits here are simply the difference between these two strikes. So you can just take the bigger one and subtract the lower strike. Is 3. So your max profits are $3, which is still a double of 150. So 150 times 2, 3. So you can still earn 100% profits on this spread as long as Apple goes towards 142 or closes above. But if you had the calls alone and Apple closed at 142, you only gained another 50 cents from 250 to 3, right? And let's say if Apple was to chop around, and guys, as I type this, make sure you're following along with what I'm saying so it will become much cheaper, right? Let's say Apple closes at 141. Okay, Apple closes, because I will see a lot of random comments and then type, so it will make more sense if you just fully focus on what I'm talking and pay attention. Let's say Apple closes at 141.20-ish, just for example. What's the intrinsic value of 139 by Friday? Is $2.20. Your calls, you actually lost 30 cents here. You're in a loss. But let's say if you had the spread, what's the intrinsic value? 220. 220 minus 150, right? You subtract 220 minus 150, right? You're up 70 cents on your vertical call spread. And 70 cents on $1.50, that's almost how much? That's almost pretty much a 50% returns. Okay, does this make sense? Are you guys following along here?
Yes.
You are, right? Great.
Yes.
Now here, what matters here now is, you know, if Apple, let's say, goes to Apple goes on a rally. Let's say, for example, it goes to 150. Now your spread, your max profits is already locked. Your max is only you can get is 3. Why? Because remember, you sold these 142 calls, right? These 139 calls are now priced at, if Apple goes to 150, these 139 calls are priced at $11, and these 142 calls by Friday are priced. Now, this is only if you hold until Friday expiry, but you can enter and exit spreads at any time, okay? And your 142 calls will be priced at $8, all right? So this, you sell to the market for $1,100, but this, you gotta buy it back from the market also, because you sold it for 1. Remember, now you gotta buy it back for $800. Okay, so you only get $300 as max profits. $1,100 you sell this and you buy this back. So your max profits that we spoke about, this 3. Okay, does this make sense? The max profits on the spread, on the vertical debit call spreads?
Yes. Ricky, I have a quick question.
Mhm.
So the prices goes to, doesn't matter, it's 150 or like 200. So the max profit is going to be like $3.
Only 3, yes.
Which is we choose the strike price from buying and sell. So
Yes.
let's suppose if we buy for 130 or the max, the sell we 140. So the in between, whatever is the price, so that's the max profit. Profit doesn't
Yes,
matter
the
price
max,
goes to.
yes, on debit spreads or the max profit will always be the difference here.
Oh, okay, perfect. Got it. Thank you.
No problem. So as long as you even pick up one small thing from you, your life becomes much easier. But now there are different scenarios to this. Let's say Apple is very volatile. Let's say you bought this today. So today's Monday, right? So today's Monday. Let's say tomorrow Apple's trading at 144. Let's say tomorrow on Tuesday, Apple is trading at 145. Are you going to get the max profits right away? You're not going to get the max profits right away. Unless Apple makes a huge move, you can get close to max profits. Usually max profits are locked in on Friday, or unless your spread goes deep in the money. All right. But let's say tomorrow Apple's trading at 145. What do you think the value of the spread will be? It will not be $3. Why? Let's go over this. The 139 calls. So the 139 calls will be trading at so $6 is the intrinsic value, plus it might have some premium in it. it might have some premium. Let's say $7. It's got $1 in premium, for example. And the 142 calls also, their intrinsic value is $3 here. And plus, this might also have some premium attached to it. And in fact, the 142s will have more premium than the 139s. Let's say the 142s are trading at $4.50 maybe, for example. All right, it has $1.50 in premium. So what's the value of the spread here tomorrow? Tomorrow, the value of the spread will be 7 minus 450. So you can still exit the spread tomorrow for 250 and lock in the $1 profit. But as long as Apple stays above 142, and let's say you want to hold it for max profits, above, personally, I would just sell at 250 tomorrow on Tuesday because Apple can easily come down below 142 in the next 3 days. Why am I going to keep my spread when I'm already up from $1.50 to 250? That's great profits on a vertical call spread. I would personally keep it. But let's say you think Apple holds above 142 for the week. As the days go by, there's something called theta, okay? Also known as the extra premium that was added. These values will slowly lose time decay. So this might be 650 on Wednesday, and this might be, let's say, $3.80 maybe. All right, the value of these options, even though Apple just trading sideways. Why? Because there's time decay coming out from the 142. Time decay is probably likely more, and this equals how much? 650 minus 380. Your profits are 270. Your spread has gone up in value by 20 cents. Why? Because there's premium coming out of 142 calls. Okay, and then the intrinsic value 139 is holding more. Does this make sense now? Yeah.
Yes. Yeah.
And let's say by Friday you're holding it. Apple's trading at $143, $143. Let's say by Friday, Apple's at 143. Now your spread here, your 139 calls, right? The 139 calls here. The 139 calls here will probably go for intrinsic value with $4.10 or maybe 5 cents, right? Like a Friday evening. And this will be going for maybe $1.15 or so. Okay, not much of a difference. And you can pretty much lock in almost a max profits by Friday for 290. If Apple's trading at 143, if Apple's trading at 147, 146, they'll give you the max profits anytime on Friday. All right. Now, let's say if you buy time on your spreads, let's say you buy, now this is the same day expiry I'm speaking about. Another one thing that I want to mention here is, let's say if Apple goes down, guys, I think why I view the 130 call is 7 intrinsic value. Well, I mean, the current stock price minus the strike price, right? 139 Ethan is in the money, right? If Apple's trading at 145, 145 minus 139 is $6 plus a little bit of premium I added. So if you go back, what I was saying, right? Now, let's say we buy this for not for May 27, we buy this for 4 or 5 weeks out or a month out, for example, right? These calls, I was talking about something about premium. The more time you buy, there will be more premium added to these calls. So you will not get the max profits. All right, you guys should test these spreads. You guys should test them on your platform and follow them along. A same spread 139, 142 for this week will be I mean, right now Apple's trading at 143, but let's say if Apple was trading at 139.20, this spread for 139.42 for this week will be cheaper than the one from next week. And then the one from next week will be a little bit cheaper from the week after. And then slowly the price plateau, then you can get the same price almost for any of the weeks after, pretty much. Okay. So I hope that also makes sense to you guys. But let's say here you think Apple dips, Apple has a chance to going to 137 and then maybe it comes back up. Now you have the vertical call spread here. All right, you paid $1.50 for this. What you could do is, let's say if Apple goes down to 137. If Apple goes to 137 from here, all right. Now both of these calls are out of the money. What you could do, it's up to you. Your 139 calls, let's say they've gone down by maybe $1. I don't know. I'll just let's say they're going at $1.50, and the 142 calls also lost a lot of value from $1. Let's say they're going for 30 cents, maybe. Okay, just an example. All right, let's say they're going for $1.30. Your spread of the value is now $1.20. And these numbers I'm just making up. These will be different in the market. What you could do is you could buy back these 142 calls. You can buy them back for $30. Okay, you can buy them back if you think Apple bounces. You buy these 30 calls back for 30 cents. Your value of these 139 calls is now how much? You initially pay $1.50 plus there's 30 cents more now. So $1.80 because you think Apple bounces from 1.437. And now you only have the 139 calls for cheaper when they were going for 250 because you bought the 140. You know, sometimes I buy back calls or I sell calls. That's the reason I do them. All right. So let's look at the, did this make sense? This small part I explained?
Yes. So basically, it's kind of dollar average value. That's what you do, right? Because you covered that price, which is you losing from the buy calls.
See, personally,
So,
I don't
so that's you.
usually, when I buy a vertical call spread, the calls I sold, I usually never buy them back because this is probably going to go to zero anyway. So I want to keep the 30 cents. Like I want to keep it. Usually for people do buy them back. Let's say if I bought 2 months out and these calls are down, I would only buy these back if I have a lot of time on Apple and these will come down a lot. And I think the bounce is going to come over the same week. I probably wouldn't, right? Because why am I going to pay 30 cents more? If Apple goes back up, great. I have the spread. I'll make the money anyways. Make sense?
Yes.
But one thing I do want to cover here now is, let's say, for example, sometimes, you know, when I had the Microsoft puts, for example, right? I had the Microsoft 260 puts. Now, this is not part of vertical debit call spread. This is just an example I'm covering for you guys to understand. I had the 260 puts. I bought them at 585, I believe. And then they were eventually trading at 16 and 17 around these levels. Okay, so basically what I did, the 240 puts, so once my puts were near the money, these 240 puts were trading for $6 and plus, I believe. What did I do? While holding this spread, I sold 240 puts for $600 to come into my account. I made my entire 260 calls absolutely free. Okay, I made these free. I think I sold further puts. I forgot. They're in the premium alerts, so you guys can check. Right now, this the max profits on this spread is how much? 20. Yeah, it's 20, right?
Yes.
Which is $2,000. Okay,
Yeah.
so as long as when plus I bought these, I collected, I sold the 240 puts and I collected $600. This position is absolutely free. Now, as long as Microsoft stays in downtrend, it keeps going down. I also lock in these $2,000, which is 400% on top of this 585. This position is absolutely free. Make sense?
Yes.
But Ricky, leaving the naked puts is definitely not like, you know, safe, right? Like, you know, I know, like, you know,
No,
if
I'm
it
not
won't
saying
go,
I had the 260 puts already. Like my 260 puts are now trading like at 16, 17 bucks, like at $16 or 17, right? And because I'm already in the money, I'm up so much, but because I want to lock in more money and I want to keep this position safe, I sold the 240 puts for $6 credit.
oh, I see what you're saying.
So I turned this into a bear put spread, vertical put debit spreads. I turned this into.
Yeah,
And
but
from this
what
spread,
happens
I
is,
lock
like,
in
you know,
the
because you're in the money already, so isn't it the 240 puts what you actually sold also get increased on their end value? Obviously, they should increase, right?
Sorry, can you repeat that?
No, like, you know, your 240 puts, whatever you sold before, should get increased, right? Because you're already in the
Not
money in
necessarily,
260
not
puts.
necessarily.
I know, not necessarily. Yeah, it should. Okay, go ahead.
If Microsoft continues trading sideways, these are going to lose a lot of value. Why? Because these went up so fast when the market was trading higher.
Yeah, I know.
The
If
trick,
it is not,
the trick here is the VIX rise, right? So when VIX cools and sides up, what happens with puts? They lose value very fast, especially out of the money. These are the puts that lose value the fastest. While these will hold value, these will lose a lot of value. Make sense?
Yeah, if it is not going sideways, it's going to be a big issue, right, for us.
No, even if it goes up, that's fine. I don't mind. Even if this goes to 10 bucks, I don't care because I have the spread in play now. But for my safety, I made this position free. What if Microsoft bounced or a banner rally came up after? Then these will lose value fast. These can go to $5, $6 within one day. Right? My whole purpose here was, like, I'm just explaining, I sold these puts to make this entire position free. And now I have a $2,000 spread free as long as Microsoft stays in the downtrend. My intrinsic value here gives me max profits of $2,600 in total, including my principal. In order for me to get 26 total on 260, Microsoft has to go to 234. Yeah. But my target here was the VIX, right? Cool this all. These lose in massive value. This loses less, and then sell them just together and lock in more profits. Profit both ways.
Yeah, actually, can I ask one question here? Actually, what happened is recently I paid I did a spread, and what happened is, they came quickly and it has a lot of time. So, and I didn't make much money, even though I mean, I didn't lose anything.
On which
But
one?
like on one of the ticker, what happened is like, it came to like, the price wherever I bought the put, and then also the one which I sold is also getting the value. So
Right.
whatever happened is, so the spread, even the spread is like, around $8, like the money whichever I got it, like, even though it almost came to the money, I didn't gain much, like not even like, $800. So because of the, quick move. So sometimes it actually spreads is going to hurt us instead of helping us.
Right. No, fair enough. Fair enough. I'm gonna keep learning. So I'm gonna share one more example here. Let's say Apple. Let's take the Apple current price. Apple's trading at 143 now, right? And you think Apple goes very high, but you think the option is expensive, but you want to do a cheap spread. If you're right, let's say Apple, you think it's gonna go up $4 from here. Just an example for this week. Okay, Apple's trading at 143 currently. So, and you think Apple goes for 150, but those calls are trading at 60 cents, but you want to buy them cheaper for before. Maybe I would buy 147 calls far out, and I will probably sell 150. Let's say 147 calls are priced at just an example, 75 cents. They'll actually be lower, I think, 70 cents. And 150s are probably priced at, let's say, 30 cents. All right. And so instead of buying these 147 calls for 70 cents, I want to buy the 147s and sell the 150s. And these numbers, guys, I'm just making up just for an example. Your max value here, your max profit again is 3. Let's say, for example, is $3. Right? And then your value here on the spread is this minus this. Why? Because 70 cents you paid, 40 cents you collected. And this 40 cents to 3. Now, let's say a 150 is a very achievable target for Apple in case the market rallies. But I'm not saying the market is going to go up or down. This move for me was to buy puts today, to be honest. And I did have some downside exposure because tomorrow is going to get ugly, I think, after snap. Now, let's say you buy the 147 call at 70 cents. You sold the 150s for 30 cents. You have 40 cents on hand. If Apple, let's say, closes at 148, now here's where the nice part comes in about spreads. Apple goes and closes at 148 by Friday. Your spread is going to be up 150%, but your calls alone from 147 will only be up how much? Not even 50%, around 45%, I believe, or so. The calls alone, okay? Make sense? Why at 148 is your spread going to be up 150%? Because the value of your spread will be at least $1, and you only paid 40 cents. You see when spreads actually work great in the high IV environment, right? And let's say if Apple goes to, just an example, Apple goes to 150. Let's say Apple goes to 150 or more, it actually hits your spread. Your spread here from 150, from 40 to 50, somebody do the math, the percentage here is going to be much higher than from 70 to 150. Sorry, three at $3, right? So 0.70 to 3, and then 0.4 to 3. The percentage here is almost twice as much from here. All right, here your spread is going to be up roughly, I think, 300% plus, if I'm not right, 300% plus. But here your spread is going to be up how much? 750%, I think. So you guys see the gains that are possible on spread, like when you apply them properly and you can spot it, especially in stocks like Amazon. Right, where let's say if Amazon's trading at Amazon's a great for spreads. I do the most spreads on Amazon, but right now it's just not the right time for me to do spreads on it. Let's say Amazon's trading at 2100, and you think Amazon closes 2300 by the end of Friday, which is absolutely possible. All right, let's say you think Amazon closes at 2300, but you want to buy the 2270 calls. Let's say, for example, you want to buy the 2270 calls, but these calls cost. But these calls are going for $7, and now you're like, man, that's too expensive. I can't afford them for $7. I mean, that's too expensive. But let's say 2300 calls are giving you maybe $4.50 in premium. So what do? You would probably run a vertical call spread here, right? The value, you decrease it substantially by a lot. You bring the cost down to 250. Your max profits from 2270 to 2300. Your max profits are the intrinsic value, so the value in between, right? You guys should all know by now how to calculate the max profits. And 250, let's say if Amazon goes to, even if Amazon runs 100 points by tomorrow, this spread is probably going to be trading at $6-7, more than 100%, while these calls might only hit 10 or 11 maybe. Amazon spreads sometimes give you a lot in return. All right. Now, there are many different scenarios here, so that I want to cover. For example, let's say Apple. Now, guys, listen to this. I'm not going to write this down. You guys have to listen. If I'm buying the a spread, if I'm buying the spread, which is in the money, like around here, your returns you're usually looking at is around, let's say if Apple, I buy, if you think Apple's just going to hold above 143 for the entire week, if you think Apple's just going to hold above 143 for the entire week, you can buy the 140s and sell 143s. You might be able to sell these for, let's say, $1.70, for example. Your max profit will not be 100%, but even if, as long as Apple holds above 143, this 170 will increase in value every 10 minutes or so. Why? Because the 143s will keep on losing the premium, which is added as the time decay hits. Does that make sense? As you get closer to Friday, this will keep going up every 10 minutes or so, as long as Apple holds above 143. Why? Because the 143s will lose the extra premium that was added to it. 140s will lose less because 140s will mainly be intrinsic value because it's deep in the money. Does you guys get that part, what I just said? So even if Apple closes at 142.50 by the end of the week, the value of the spread will be $2.50, which is much higher than 170. And your break even here is 140 plus $1.70, 140, 170, and you're still giving your room on Apple for Apple to come down if it comes down. Yeah, makes sense?
Yes. Yeah. So basically, because it's we're close to our strike price, we can see that because we're selling 143. So even if it goes to sideways before the Friday, even let's suppose on Thursday, so still we have a value. If it's 142, if it's playing 142, okay.
Yeah, value, because remember, these 143 will have a lot of premium added. Right, 140s will have more intrinsic value than the 143s, less premium added on 143. And the whole target here is to gain that time decay. You know, sometimes you buy options, the stock's not moving, but the option keeps going down. That difference, that time decay is what you want to put in your pocket. Like, for example, Tesla today, for example, I'll give you the spread that we did today. So let's go over that. So let's go over the Tesla spread I did today. So I did the put spread, not the debit call, what we're going over. I did the puts, but I'll just go over an example. So basically for June, what's the alert? Hold on. So Tesla June 10th. So I bought June 10th. All right. So 650 puts. Now these puts were going for, I forgot the price, but I think they were going for around $44, if I'm not wrong. This is too expensive for 650 puts. The intrinsic value on these is how much? If I buy the 650 puts for 44, what's the intrinsic value, guys? Anyone? Anyone?
It's 650 plus 44?
No, brother.
No.
606.
Oh, 606. Okay. Oh, we're gonna actually minus. Okay.
Value. So see, when you're doing options, you want to learn these things. These are the things you need to, like, right away should hit your mind, right? And then I said, oh, these are too expensive. There's increased IV, but then I looked at the 600 puts. These were going for how much were these going? I paid $17.40 for my spread, but let's just say 17, for example, to keep the so 27, and these were going for 27. So I said to myself, you know what? I'll sell the 650s. I'll buy the 650s. So I will buy the 650s and I will sell the 600s to finance, right? And my total cost here was, 17, right? My total cost was 17. Now this brings my intrinsic value down also on the spread. My intrinsic value here is how much? 650 minus 17. So as long as Tesla comes near 633 or comes below, you know, this level by June 10th, this day, I will gain premium. Now let's say Tesla, now I bought time on this because the reason I bought time, so if we go on Tesla chart, because it can easily bounce towards this zone. I understand it can bounce towards here and it can bounce towards here and it can also bounce towards here. And it can actually go here and by June 10th still fall below. All right, this can happen on Tesla. All right, so that's the reason I bought time instead of this week or next week. I bought all the way towards June 10th. Two reasons I mentioned when I sent the alert. Number one, if Tesla happens to go above 719, 750, if Tesla gets here, because on the weekly I'm bearish on Tesla, by the way, if Tesla comes here, my goal is, and Tesla holds here, is to buy these back for cheaper. My goal is to buy these back for maybe under $6 or $7. These 600 puts, maybe $5 or maybe whatever it may be, and then hold the 650 puts alone. All right. And then if Tesla sees a downturn, even if these 650 puts come to 30 bucks or 35, I can sell this whole spread like separately in massive profits. Make sense? Now, let's say, for example, we go here. Let's say Tesla tomorrow goes to 600. All right, Tesla looks ugly right now. Let's say tomorrow alone. Let's say tomorrow Tesla goes to $600. All right, Tesla's drops a huge. Am I going to get the max profits of 50 bucks tomorrow? I will not get 50 bucks. The maximum I'll get on this is probably 26, 27. Just from experience, I'm telling you, around 26, 27 they'll give me. Okay, maybe 28. All right. Why is that? So let's go over this.
So there is a time left on this. So.
Yes, there's time left on it, so which is premium. But 650 puts will be priced at, let's say, 70 bucks. Just an example. I'm just going to make up some numbers. Right? But these 600 puts also are going to be massive in value. These puts are not going to be cheap. They'll probably be going for at least 40, let's say, for example, at least 40 bucks if Tesla is trading at 600 tomorrow. All right, maybe more than 40. Okay. So my value that I'll get tomorrow is 70 minus 40. So 30 bucks, right? Because I'm selling it way before time because there's still time left and 600 has a lot of premium added to it. But still, from 17 to 30, would I take this on a small account? Hell yeah. So if I have $25,000 cash, for example, I don't want to buy something for 44 bucks. That's 20% of my account. Okay. But for 17, I can think of it, right? And then I keep the rest of $23,300 in cash. And this position, I let it play out. If it plays out, great. If it doesn't, okay, on to the next one. All right. And then you stay on the majority cash. Just an example I'm sharing. Okay. Did this make sense now? Because with this, you guys will, because sometimes what I see traders, as soon as your spread is in the money, once your spread is in the money, you think you're in max profits. That's wrong. You're not in max profits unless it's the same Friday is expiring, you're locking in the intrinsic value. Okay. Here, you will get profits. Now, the longer it holds in the money, your profits keep increasing until you get closer to the Friday. Well, unless you get deep in the money, then the strikes, both strikes will lose extra premium. Why? Because there's only intrinsic value associated with it now. Then yes, you get closer to your max profits. Does that make sense?
Yeah, you'll get 33K.
Yes.
Okay, guys. Now that was 30 minutes on what I explained. Anything on strictly on debit call spreads? Any questions? Just on debit call spreads. Vertical debit call spreads is when playing stock to sideways or upside, where you think it holds above the second sold strike. Any questions on this? Because I want to keep these lessons for half an hour, 40 minutes, so it's easier for people to watch. So any questions, go for it, just related to this. Anyone?
No, so far it's good.
Yeah. Let's say, for example, if you think a stock holds a certain level, let's say, for example, Qs, right? If you think that, you know what, Qs on the weekly, it looks like it's bottoming, and you think Qs hold this certain level, just an example, you think Qs hold 280 or this level right here, you can buy the 290 calls and sell the 300s 2 weeks out. So as long as Qs bounce a little bit and they just hold strong, you can make a lot of money on those spreads, even though the calls will lose a lot of value. Yeah. Like, for example, any stock that you think is bottoming, PayPal is nowhere near bottom, by the way. That's just my opinion. But let's say if you're somebody and you think PayPal for the next 1-2 weeks holds this zone, there's a strong support zone, and you think PayPal holds this strong zone for the next 2-3 weeks, instead of playing calls alone, which will be expensive, I will probably buy the $80 calls. So I would probably buy the $80 call. This is just an example, guys. Okay, I would probably buy the $80 calls and sell maybe the 85s. Right? And this spread will probably cost me around 250 or so. And as long as PayPal goes above 8250, 83, I can make some money on it. Make sense?
Yes.
So the calls alone will be $5-6 bucks. So even if PayPal just holds sideways here and does nothing for the next 2-3 days, you know what? No profit, nothing. Sell this for break even, you're out of the trade. Yeah. And if it goes down, at least you did not buy those expensive calls. Fair enough. So when sometimes stock holds, let's say, for example, this zone right here was a very strong support zone, and you can buy time on your spreads like I did on Tesla. Like this was a very strong support zone right here. This was a very strong support zone. So if you were smart and you're watching this name, then you know what, it's not going to continue going down right here. This was a strong support zone. As soon as it hit this zone right here, right, you could have bought 2-3 weeks out on your PayPal, like a spread for $2, $3, and a $5 spread. Like the $5 value wide or maybe 10 value on this big green candle, you could have taken off 100% of the spreads. Or even if it held here and did nothing, you could have still made money on the spreads. Make sense? For example, right here. Same thing here. Instead of buying calls at this strong support zone, you could have bought spreads and made money. As long as people held sideways, and that's exactly what it did. Make sense? So when you think a stock's falling and you think the stock might bottom there for 3-4 days and it goes sideways, you can double your money on spreads. I've done this many times and you guys literally can. Like here at 180 to 180, I would have bought the 180 calls and sold the 185s. And on this sideways movement, my stock on that spread, I would have made at least 70-80%. I would have bought it for $2, $2.20 and sold it for $4 just on this sideways movement, because the 185s would have lost all the value and then the 180 would hold the intrinsic value. Make sense?
Sure, got it. But the only thing is, if it is farther out, like, like 2 months or something, usually they don't lose much of the theta. So
So
you
2
don't get
months, if you're playing 2
yeah.
months out, then I would buy it probably with a very strategic, but here, like I would probably go 1 or 2 weeks out max, like at these levels.
Yeah, it acts like a calendar, or you can pay like a calendar.
Yeah. Another thing, keep learning. If I'm going 2 months out here, if I'm going 2 months out on this spread, hey, you know what? Then I was probably looking for a bottoming pattern. On this candle break, I would exit my spread on near break even, because you would not lose too much value. I would exit with a 5-10% stop here as soon as it breaks down here. That's another thing about spreads. Like the calls will go down a lot, but your spread will not go down by as much. So if I bought the spread for 220, I will exit at 220, I'm out.
Yeah, for suppose today is a JPM, like,
right. Yeah,
you
JPM.
bought it like July, right? So there is a
I bought puts alone. I bought the July puts on this.
Yeah. I mean,
my theory on JPM is not a level or nothing. I bought these based on fundamentals, based on the financial sector, certain things that I know, that I may understand, I believe.
Yeah, I see what you're saying. That's why I thought of playing calendar there so that I can reduce my premium. So, but I didn't get it today. So
if you want to play calendar, you should have just told me. I mean, we could have easily sold this week's puts, right, and got or maybe 2 weeks out and then hold. But the financials I don't trust. This can easily break 200 MA anytime. That's the only reason I didn't do calendar spreads on this. The calendar spreads I would have done here on Friday, if anything, like near these lows of right here. Right, calendars I would have done here.
I see.
The reason being is because this support would have held. I would have sold the 110 puts for next week, and then bought the week after 110 puts. Those I'm going to go on to calendar spreads also. I do want to start giving those alerts out. Do I do them? Yes, I do them on my own, but I don't alert those because not many people understand these things in the chat yet. And I need people, now that I know that you know these things. Sarmad is pretty smart with these. Bucky is learning a lot about these things, and many others who are here putting the work in. I can give you guys all the alerts you guys want with these things. Like strategies, I'm really good with them. Anything else, guys? Well,
yeah, thank you, Ricky. That's all. And we want main, I want especially that spark.
No, of course. And guys, make sure you guys study the post gamma, some good information on it. So these are vertical bull debit call spreads. All right. You will can see these names. Some people say debit call spreads, some people will say vertical spreads. But this is the full name. All right. And thank you so much. This was a short and sweet lesson on vertical bull call spread. This is basic. If you understand this, then the next week we'll probably do bear call spreads, right? Then we'll do put spreads. Then we'll do bear put spreads. We'll do all these guys, and all these strategies like from one by one. Do I look at gamma and delta? Not necessarily, because once you start doing them, you will realize, like if I was to do this spread right here on JPM, just by looking at it, if I was to do 124, 126, I already know it's going to cost around 90 cents or $1, right? And then just based on that, it depends. But no, I don't look at them. Only sometimes. If I was to do GME or AMC, then I would probably look at it because there's a delta on my bought price. Hold on. If my delta on my bought call is, let's say, for example, 50 cents, and my sold call is 45 cents, I probably wouldn't do this because on every $1, my spread is only going to go up by 5 cents. All right. But if my delta on my sold call is, let's say, 35 cents, right? My every $1 move, my spread will go up by 15 cents. This I will probably do. All right. And then with this, your theta also kicks in, right? How much theta is involved is my stock holds a certain price. So now it gets more and more advanced, right? So that goes to Greeks. But once you understand the basics of this, then you can apply the Greeks and then get the more understanding, I guess. But this obviously requires a lot of learning and patience. Darren is asking if I said something with a VIX helping or hurting the spread. No, not necessarily. Not necessarily. What I said was on Microsoft, when I sold the 240 puts against my 260, VIX was high. And then the next 2-3 days, as soon as the VIX cooled off or went sideways, those 240s were going to lose much more value than the 260s. Why? Because 240s were way out of the money. Right. So that's what I said. But there's a lot.
Yeah, sorry to cut you off, Ricky. Actually, so basically, if it's we are getting like expensive calls, so premium, I mean expensive premium for any call. So it's better to look for spread, because you know, you still got the opportunity. You can go through to get some profit, but there's a limit. Yeah.
Sometimes I will buy naked puts, like naked puts and calls. Like last week I did a spread on Amazon last week, which was amazing, right? For the downside. Like Tesla today, those puts were just too expensive. And Tesla, the reason I did a spread on Tesla, it was simple. Why? Because we come down quite a bit and we are a strong support. Because if this Tesla holds here for the next 1-2 weeks, let's say it goes sideways and more puts come up in the market, those puts are going to lose a lot of value. So I bought time. That's the reason I bought a spread. That if for 1-2 weeks this year, then the next week I just need one big flush, or maybe in the third week, and my spread will be good. Yeah, even if Tesla trading at 620, let's say if Tesla trading at 620 by June 10th, right? The 650 puts intrinsic value is 30 and my spread value is 17. I'm still up $13. But the 650 puts alone are worth trading at 44, which will be down if I bought the 650 puts alone, right?
Yes, makes sense.
The spread will be up almost 100%, while the puts will be while the naked puts alone will be down. So these are the things that you have to get into. Does the OI Andrew, it depends. It does. It depends. The reason being is because sometimes like Tesla 650, 600, even 700 will have a lot of OI now, right? All these levels will be in play. Nobody knows where Tesla is going to go. It's just based on certain things. But options interest, yes, sometimes it matters. Sometimes it matters, right? Because if I'm playing to the downside, I do want to see, let's say, for example, if I'm playing Tesla to a downside, I want to see if the more OI is at 650 or 600, then based on that, I might take a higher risk and buy the spread further out for more gains. So it really depends. So once you start doing them, all those things will also make sense. Well, guys, with this, I guess we'll end it. Thank you for attending. This was only for premium members. I hope I was able to help. Even if you learned one thing, and if this was completely new to you, congrats. I mean, you can learn as much as you want. So.
Yeah, no, thank you so much, Ricky. No, it's helped lots because a lot of things, because you know, for those are a little tricky for the vertical calls, but now it's a little clear for me, because you know how to. I thought as a profit wise, like I didn't know that there's a limitation, and when you have opportunity to get the like cheaper calls to buying a spread, so it's better than naked calls. So definitely, it's a lot, yeah.
And this works both ways. This works both ways, right? And but I mean, so this was only the one that we did. This was the most basic one to start with, and we'll go on to the next session. Not next Monday, the following Monday. We'll go on to the next one, and I'm gonna build these series up so anyone that wants to watch them and can learn a lot. And then after, you know, the verticals will I will be able to cover it. Hopefully by next session I'll cover, and then you can also do these vice versa also, right? And so yeah.
Ricky, can you go over the Gamma gang and Spot Gamma thing for 5 minutes or 10 minutes if you have a time?
Gamma gang. Why don't I do that tomorrow pre-market? I'll start early with the new data on hand.
Okay, it's fine.
And then I can talk about today's action with that, because I think it'll make more sense.
I read it and I understand it, but especially that, you know, that like weird clouds on the Gamma gang, they give a lot of, like, you know, blue color skies and all those things, right? So those things which I never understand, because I don't have any documentation on this. I didn't find anywhere.
Those okay, I see what you're asking.
And then they talk about left tail and right tail, right? Actually, they put like four four entities, like four indicators on one graph. So I totally get confused, like, which one is what and all.
No, that's the concentration of the OIs and stuff. Okay, I see what you're asking. Okay, but do you understand the gamma overall?
Oh yeah, like, I understand the gamma and the delta hedging and all, like, but like, where is the concentration of the more gamma, like negative gamma or positive gamma and all those things. But
to understand the tail risk and their crash risk, the calculations they use, because that's theirs, obviously, right? I mean, that's their product, right?
Yeah, they say that, Jim, like Jim Robot, like, it's they named it as, like, the code guy, the code person, the code that executes, they name it as like Jim Robot.
Yeah, right now the crash risk is still there 3x based on their data, and so I see what you're asking. Okay, let's go over that. Let's go over that maybe tomorrow if they post it early, or the day after. Like, I can spend some time on it according to my knowledge and what I understand from it. But the most important thing you want to focus on is the right and the tail, left tail. That's the tricky part. So that will go over. Don't worry. I got your question.
Yeah, thanks.
But I'm glad that you're asking. At least somebody's looking at those things. So that's good to know.
Yeah, there's one more thing which I want to ask you guys are, like, whenever you guys say that, on this cloud touch, so let's say we'll enter here. That's like, can you guys help us to understand like how you guys are taking that decision on? I know I did not see that you guys used this cloud thing before. I'm just observing that nowadays you guys are using this cloud, right? Repster calls. So like, what is the like, that idea that you guys are forcing, enforcing that, okay, this is the touch, maybe this is the support and this is the sentiment on this, maybe we can take it here. So what is that giving you that indication here?
I'm gonna go over this. This is the Repster cloud. It works best on trend days. Okay, this works best on trend days. Let's say, for example, Tesla right here now on May 20th. It worked great. All right, every cloud touch on the EMAs here. So if I go on the settings here on the Repster, you guys can see the inputs here. You got these EMAs 8, 9, 5, 13, the ones that they use, the different ones. All right, and then here are the clouds. This is quoted by whoever the Repster guy is, I believe, right? I don't usually use it, but only on the days I spot trend, I use it. It worked beautifully on the trend day.
So you're using, like, whenever there is a actually pullback, so maybe you can enter there and then you can capture that trend, right?
Yes, downside or upside.
It's more or less like, same as like, say SMEs, like, only thing is whenever that item, that strike comes into that lines, and then maybe that is just you're trying to reduce your cost there, so that because it's cheaper there because it's pulled back.
Yes. So the day the market is trending, you want to look at the financials, tech, you want to look at the consumer discretionary, you want to look at all the sectors. The day market is weak and they start selling off at 10:30, like this, 10:30, and they start selling, and the market is weak, is a trend day. Like, trend days, you should be able to spot them early. All right, because we did nail Amazon on this trend day when it was going down. You can put this here and you can use this. Like, let's say, for example, on this rip up, as soon as it was building a bear flag and you saw the weakness coming in here, you could have used this for put entry. And your stop would be where? A close above these 1025, 1030 candles right here. As soon as it's above the cloud, you stop out for your minimal loss. But now you buy this, you sell it. Once it's far from the cloud, you take your profits and then you wait on the next touch. You wait for the next weakness, the rejections here, and then you enter your next position here. And these work great on the trend days. All right. Fair enough.
So today, like, that Ricky entered, right? He's saying that it's on the day cloud touch. So I'm entering here. So
which position was LB? I think says something. I
think LB. Yeah, that's what I got confused, because it's not a trend day, and I did not understand like what exactly is meaning by like cloud touch.
He's very good with this. Maybe he did spot something that he was playing. LB is very good with this indicator, right? And
yeah, because these clouds are usually, these are nothing but just moving averages. So just if it goes to between that 8 and 13, that means there is a pullback there for you. So to enter onto that trend, right? So it's just a moving average. Other than that, there is nothing here other than that flashy colors, right?
Yeah, like for today, for example, like I don't follow this all the time, only some. Like today, this highlighted area was the bouncy area it was giving signals off of. But again, I mean, this is something you practically have to follow. For me, anything I do, I practically follow for many months. Like the gamma, I follow this for many months before I started talking about it in the group. First, I made sure that this is something I want to follow and it was accurate. I spent a lot of months on this. It's not something that I just came up with. I started.
No, I understood. You draw those gamma that spot gamma profiles, but also do you take the volume profiles there? Like let's say that SPX, right? Those SPX. So we need to, let's say that there is a huge volume that is traded there. So that means there is a huge support involved there, right? So I mean,
the OI is I get that after hours or next day. The spot gamma levels that I get for the current day, I use them when I see them in play, right? And I use
so
them.
you use those spot gamma levels as support and resistance, or
not necessarily a support and resistance. I am not a support resistant trend line guy. Keep learning. I play based on options with the real data. Like this ES today, I had all day. I was watching. Right.
oh, you're using Hyro, that real-time options.
I get the I watch the real-time option overall, and then like so this is ES. If I go on SPY, like total, like SPX for example, like SPY.
So that means you can identify the trend. That means people are selling calls that buying those puts. That means you're identifying their sentiment.
Like today, for example, on ES, right? The basic takeaway was the overall flows were bearish. They were selling calls, they were still buying puts. The overall sentiment was bearish. I'm not going to go too much in detail into this, but you can see that ES still held up. To me, it just tells me that this rally it might not last. And now I know that for Monday, I actually have it in a book written that these deltas, negative deltas were built up. I'm going to look at the options interest tomorrow, how they behave. And then tomorrow, I'm also going to follow and see what happens. And when I see the trend with the trend, my confirmations are met. I see the OIs, I see the overall market, I'm going to take my play. Now, this is not something that I can tell you that, okay, no, buy puts based on this. No, I cannot tell you this. This is something I need to follow for a few days, and I've been following for many, many months. I have that data on the back of my head. But by looking at it, I cannot be like,
yeah, actually, one of my, like friends or something, what they did was like, they use this indicators, and they also use the sentiment, and then third one, they use the heavily on the, like, the flows, like if there are repetitive flows on the ticker. So, and then that too, they are like long period, like let's say that the further month of like 4 weeks or 5 weeks,
right?
That's when they are going to take it, because they have like all the confirmations. Flow is there, repetitive flow is there, and the sentiment is there, and then these indicators or technicals are playing out. So that's what they played out. And then I don't know all these things. I burned before. So I'm just telling someone, if it's like, use these things: sentiment, technicals, and flows, these three.
See, one thing I want to tell you, let's say for on ES, for example, like for JPM today, there were no put closures at all. Let's say, for example, on ES, when I was watching it today, this tells me not to buy calls. At least the market can rip as much as it wants. I probably won't buy calls. I'm just going to wait for this negative gamma to build up, and I know when the market's probably going to fall. I'm going to take my positions. I was going to tell you something very important, which I forgot. But if this trend lined up with my theory, for example, market was going down and I had this trend in the same direction, I probably would have added some buy puts along with it. But this rally is basically telling me it's out of here, because one thing we have to understand, the market is heavily driven by options flows. A market today is heavily driven by options, right? So if you guys know these things, I mean, Starbucks, for example, today,
I know, but because the dealer or the option writer has to make the hedges, right? So obviously he's the one actually moving. I mean, options are the ones moving the direction of the hedge he's trying to play. So
exactly.
But the thing is, it's not the only one. If it is pure selling, right? Pure selling means just like in liquidation, like hedge funds or some institutions are liquidating. It doesn't matter now.
Yes, what I could tell you right now is the hedges in the markets are not as heavy. So when the next leg lower comes, it's going to be one of these. It's going to be very unexpected. It's going to be something like this. The next big move down will be something like this. Nobody's going to expect it. People will be bullish, and they're just going to drop on your head like something like this.
But the thing is, like, you guys, play with this SPX and all. But what I observed is, like, usually the hedging and all the thing is done by market maker through futures. Like, he goes and let's say that, he knows that, there is a huge covering of those puts that those bought. And then what he do is obviously he's going to buy the futures, right? So to make that delta neutral, right? So, but that depends on that. And then obviously the SPX levels will move, right?
That now for that, you know, there's something called a bookmap, ES bookmap for futures. Do I watch that? Yes, I do watch that. But there's so much information I can pass on in the group. Like people will get lost. There's only so much information I can share. Like where you're getting it, do I watch all that? Of course I do. But how much can I really share in the group? You tell me. And how much can people actually
No,
absorb?
no. I'm just asking because see, I'm telling you this one because, all this thing, what I learned after I lost. That's all it is. Simple, I'm saying. The only thing is, I don't understand. I just came here to, just join. I want to learn from you guys because, you guys are, how do you guys are entering trade ideas, especially when you enter, like on what basis you guys are entering? What is the reason behind it? So that, the people like me, okay, oh, this is the reason that, Ricky and LB is entering, so.
This JPM trade, it has nothing to do technically. I'll be honest with you. It has nothing to do technically.
Yeah, you told me already.
It barely has anything to do with flows. This is my fundamental understanding of the financial world right now. That's why I entered. I'm just using this because I think they're going to get sold off in the coming weeks. They're going to sell these off hard. That's my understanding of fundamentals, right? That's based on completely something different. Like I did not enter this by trying a trend line. I did not enter this because of this support. I simply entered because I saw some good resistance here and I saw an opportunity of a 10-point bounce to buy some puts. That's all I saw. And those puts, I lost a lot of value. Why? Because of this huge move up all day. And I entered right near the top where, not that I'm not trying to call no tops, like none of that. I bought into July. I bought time for July, right? This is the time I bought for JPM. And by then, even if JPM goes up here, there will be a big drop in my understanding of options on of the banks, right? That's my risk and that's just my fundamental understanding. I'm not buying this based on no trend line, none of that, right?
Yeah, I see what you're saying. You explained me that you bought JPM because of the fundamentals that you looked at it.
That's I mean, can it rip? It can absolutely rip. I have no idea, but I'm gonna like some things you just gotta do as a trader, which you understand and you believe in.
Yeah, probably tomorrow you're definitely going to get paid because of what happened today with Snap and Google. So we can see that, that's already, showing it.
We're turning a lot of bullish today. I mean, I don't buy that bullishness. So that's why even with Tesla, I see me personally, I prefer missing the rally that's going to happen right now. I'd rather miss that rally 100 times. I missed this entire rally in March. I missed this entire rally and I just watched it go up and up every day. I was like, it's okay. And then here's where I started entering my short position right at the top. And then boom, I was rewarded. Apple also, it was people were turning super bullish here. While people were turning bullish, it's all in the premium alerts. You can go check the dates. I started selling bear call spreads up here. I started collecting premium right here. I started collecting premium. Microsoft also, because of the understanding of options right here, I started entering 260 puts into June. I started entering the 260 June puts and they paid big on this one huge drop. I took those options from 5 to 17, 18 in front of you guys. So some things you just gotta swing it, right? This is a downtrend market. Play it. The fundamentals are there. They're supporting it. Play it until it lasts. It was fun. Because puts go up in value a lot faster than calls when the market falls.
Yeah, of course, because you're adding volatility, Vega.
Yes, because it's not just deltas being added, it's also volatility being added. So puts go up a lot when the market falls. And keep learning. What's your name?
My name is Murali.
Murali?
Murali, yeah.
Murali.
I'm Desi guy, man.
All right, great to have you here. Well, thank you guys, and thank you, Murali, for bringing up those topics. I think it opens up the mind for people that, wow, there's so much in the markets, Well,
there's so much, but the only thing is that my problem is like, there is so much there, but I'm not using them for my, understand, like, playing.
The biggest tip I will ever give is this. There's nothing bigger than this. All of you guys, there's nothing bigger than position sizing. Nothing. There's absolutely nothing bigger than this. If you learn how to position size yourself in this market, you can be more wrong and less right. You will win the markets. Position sizing and risk management. These two things. I'm really back about 7-8 years ago. I also blew up many accounts when I was young. Not one, not two, but many. Like at a small age. I learned. Market made me humble. God bless. See you guys.
Perfect. Thank you so much, Ricky. Thank you. Thanks.